everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, as we know, the markets continue to be very volatile, a lot of uncertainty, a lot of unknowns in terms of inflation. Will we see stagflation? Are we in it? Will we have a recession? What does that mean for stocks, bonds, and of course, some of the other risk-on asset classes like crypto and digital assets? So who better to bring into you today for some perspective on all of this? Someone who has vast experience in the markets going back a few decades. Harris Fricker is joining us. He is the president of Stifel GMP and FirstEnergy. Harris, great to have you with us and to share your perspective today. I mean, you even worked in Silicon Valley at the beginning of your career, if I'm correct.
Yes, there were pterodactyls in the sky back then, Catherine, but yeah, I was in Silicon Valley
Go ahead.
back in the very first wave of the internet in the late 90s and early 2000s. And it was a fascinating time. And, some of the trends we're seeing with this mini collapse are reminisce of what we saw in 2001, 2002 in what was then a nascent space on Internet 1.0.
So it sounds as though you're likening the internet back in the day to perhaps the volatility that we're seeing in crypto, correct?
Yeah, I think, you have to pull back a little and sort of look at this. I use the term ecosystem, not accidentally when I describe, the digital asset world. And that's because it's still, nascent in its latest iteration. So in an ecosystem, certain species survive and excel and others don't. And this is a pretty rapid response ecosystem due to the lack of regulation. So you get effects and cause, the linkage between cause and effect pretty rapidly through the system, and we're seeing that. But just like, Internet 1.0, which was all about transformation of the transmission of info, this phase is about transformation of the transmission of value. There'll be parts of this ecosystem that are proved viable over time, and there will be parts that will be proved non-viable. And we're seeing that shake out, pretty dramatically in real time here now. But, I think there are a couple things to look at currently in the market, and then there are a couple things to look at in the broader scale where the potential here is still, astronomical. And the value creation, I think, will be deeply impactful.
Interestingly, so it sounds as though you think that there's going to be a lot of opportunity within the crypto or digital asset world.
Yeah, I think currently what we're seeing, and you would understand this, given your background, leverage, concentration, collateral don't go out of style. And one of the things we're seeing with this meltdown is really the lack of just standard risk management practices at some of the companies involved. So we've got undue concentration, leverage to buy volatile assets, insufficient collateral, none of which are specific to the digital world. But as you know, if you get those wrong, it can be a very challenging financial situation. I think the second thing that we'll see if we see risk being mishandled, we'll see regulation. And I think, the SEC has long been looking at how to come into this space from a regulatory perspective. And I think with this sell-off and the emphasis on currencies and tokens, you'll see the SEC come in here and start to regulate around the issue of, are these companies selling securities or commodities as assets? And frankly, I think inevitably you will see the focus come via the Howey test, which is a very long-standing U.S. court approach to the determination of whether you're selling a security or not. And I think you'll see the Howey test applied pretty broadly And, there are lots of activities here.
Okay. We're going to take a quick break. We'll be right back. Eris, we were just talking about your view that we will likely start to see the SEC regulate the crypto digital asset world, broadly speaking. I'm assuming you would think that that's a good thing, that kind of gives some credibility and stability, perhaps. I think that I still wonder, though. I mean, one of the reasons why the crypto Bitcoin world exists is because they want it to be more of an open system, less regulated or impacted, I should say, by institutions like the SEC or central banks. So it's a bit of a dichotomy, isn't it?
Well, when you think of it, I mean, Bitcoin back in 2008, when you read the Bitcoin treatise, it's clearly a protest treatise, and it was written, in no small way in response to the global financial crisis arising from the collateralized debt obligation market in 2008. So you're absolutely right. There's a libertarian contingent, the Austrian economic school approach to currency, embedded in the mindset surrounding Bitcoin. And yeah, I think, the technical issue, and it goes to the philosophy of the entire Bitcoin space. The technical issue that you hit on, Catherine, is if you remove lawyers, accountants, bankers from the transaction set, which is what distributed ledger technology is all about. I mean, we're talking about decentralization of decision making by replacing those traditional intermediaries with code, effectively. And these codes are in the form of algorithms that enable execution of smart contracts. So your ability to transact moves from traditional intermediaries, facilitators, to code. And we all know that code is only as good as its comprehension of the cause and effect arising from that particular issue. And we also know from many years in the financial markets that trying to contemplate cause and effect fully where financial assets are concerned is extraordinarily challenging. Some of your viewers will remember the PhD motivated excellence at long-term credit, which was a can't miss till, standard deviation events meant it was a pure miss, and it was massive destabilization of the market. So I think one of the challenges currently is how do you marry decentralization based on code and the accompanying notion of the immutability of the ledger with the need traditionally in financial services for the ability to interrupt for two things: to validate the client for fraud mitigation. So you have KYC and anti-money laundering, which are fixtures of the regulated environment, which are, obviously very important. So that regulation, to me, is vital. But when you come back to the technology, the central question is, will the code in the smart contracts evolve sufficiently so that we get ongoing generational improvement in the smart contract code? Because if you look at an algorithmic stable coin like Terra and its sister coin Luna, that relationship was based on an algorithmic hedge. And while that hedge held up through lots of market iterations, with the volatility in early May, we saw that algorithmic hedge break down and 60 billion of value vaporized from the market. So it'll really be, how do you ensure fraud mitigation through validating the customer in a decentralized environment? And just as importantly, number two, how do you pattern interrupt a transaction? Because on the blockchain, of course, the transactions are immutable. Once done, they cannot be altered, which makes that very attractive, in a country where a despot may come into power and try to change the land registry. It's one of the things blockchain is designed to prevent. But that immutability means you can't reverse a transaction. And reversing transactions is literally the lifeblood of the transactional world of finance.
We'll take a quick break. We'll be right back. Harris, I have to tell our audience, during the commercial break, I did say, you're so good at taking something that's so complex and really making it understandable in terms of kind of the science and technology behind what's going on. Thank you.
Well, I do love this stuff. I believe the algorithm for wealth creation is rooted in disruption. And I still think the intersection between analog and digital is by far the most interesting thing in our entire world.
What does that mean?
So it means that if you look at the web currently, the web is moving from the individual as an observer to the individual as a participant. And that's all tech enabled through compute. But when you boil it down, where I see tremendous opportunity is there is no question there is a digital world being created. That's really the analog and sister to the real world. And we are seeing individuals now able to move from observing in the web to participating. And they'll, as we see, and it's early, they're participating via a digital avatar, which is a digital representation of who they want to be in that world. The interesting thing about that on the business side is if people are spending large amounts of time in the digital world and they move from observation to participation, then the next thing they're going to do is transact. And that means that branded entities are working overtime on how to translate their brand into the digital environment. So we're seeing right now fashion shows, movie promotions, and the like in the digital world. But very rapidly, we'll see the digital world really become kind of a mirror to the analog world. And it will just be absolute commonplace for an individual to have commingled with their analog ID. They'll have a digital avatar, which acts on their behalf in the technology world of 3.0. That's not going away. That will transform the next wave of brand and business. Because think of it, if you're a branded entity and you can go into the online world and with very little friction, translate that brand, which already has a following, into sales, that's a very powerful opportunity. And we're seeing branded entities take that in a very aggressive way.
So, Harris, I want to then kind of translate this to the viewer in terms of where should they be spending their time in terms of thinking about where they want to invest without really knowing all the nuts and bolts. But how can you direct people in terms of what to look at?
Well, I think the first thing I look at is what's going to happen vis-a-vis the maturation of Bitcoin. Bitcoin as a currency, given the processing speeds of the network, which was never really intended to be a high transaction, it's too slow to be a transactional medium. There are lots of digital currencies that will enable that. So I guess we'll look to see whether Bitcoin evolves fully as a store of value It's been typified as digital gold by many commentators. It's currently, from a correlation perspective, in this meltdown, it hasn't acted like digital gold. So I do think close scrutiny on the evolution of Bitcoin, especially as we move from coin rewards to miners, as we go into the end innings on Bitcoin issuing new coins. As everyone knows, it's capped at 21 million. And then the network will move from coins as reward, where the miner is rewarded, the successful miner who solves the algorithm is rewarded with Bitcoin. That will move to the successful miner is rewarded with transaction fees. So one of the things I'm watching, Catherine, is will we see a maturation of BTC as a store of value? The second thing I would say is a big opportunity is tokenization, but tangible tokens versus memes. That's going to be, I think.
Okay, we'll take a quick break. We'll be right back. Harris, we've gotten so much great insight from you on the crypto and digital asset world. I actually thought we'd start in reverse, also given your experience in the equity markets from a macro perspective and what you make of all of this market volatility. If we're in a bear market, or given the fact that we've seen such a pullback, are there opportunities? And of course, the big debate going on right now is what is going to happen with energy and inflation. Obviously, given the lack of supply and the war in Russia, Ukraine. I know that's a mouthful there, but what are your top down views these days?
Catherine,
Yeah.
the biggest macro factor we've seen since World War II and the Marshall Plan has been the government response to COVID. And if you look at Canada, we've essentially spent the equivalent of dollar adjusted what we spent on World War II. That is a massive spending program, much of which, given the lockdowns, was designed around income replacement. So no real infrastructure improvements, despite the amount of dollars expended by countries to combat the pandemic. That had to lead to inflation, and blaming the current inflationary spiral on Ukraine and supply chain, of course, those are factors. But at 35,000 feet, we have the largest orchestrated government spend on this planet since World War II and the 1946 Marshall Plan. That had to have an inflationary effect, and that's being borne out in the economy today as we speak.
And so, what does that mean then in terms of your view on the markets? Because the markets are trying to figure out if the BOC and the Fed are going to raise rates, cause a recession. What does that mean for valuations? How do you see it? Like, are you buying or are you staying away from the equity markets?
Well, I think currently in the market, there's very little direction. So there's so much information sloshing around, and people are trying to set in their mind the relationships between inflation on the one hand, which is, of course, being offset by an increased interest rate environment to try and quell inflation. But then as you increase borrowing costs, you negatively impact the economy. So there's a web of effect, the result of which is still quite fluid. What concerns me at the macro level is in the wake of this spending by governments. If we had something like a 2008 event, given the prior spending, the leeway of governments to respond to that, their ability is considerably lessened. And that lack of optionality in the system concerns me. I think the supply chain logistics, the hangover effect of COVID in both the labor market and just basic production, that still has to be borne out, and there's obviously arising from that. There's confusion as to whether we're entering recession or a short period of down market where we'll even out. And you just watch the news. There are loads of people vastly more informed than I, and the range of views is everywhere.
Yeah, it is everywhere. What do you think? I've only got about 40 seconds, but what do you think is a good way to protect your portfolio or position yourself given all the unknowns?
I would currently, I can only say what I do, because I'm certainly not a portfolio manager, but I'm in cash in a good way currently. I certainly have long-term assets that I have no intention of selling that are good, liquid, big cap stocks. And then as we get into typically the dog days of August, I think there will be buying opportunities. But currently, I'm just sitting, waiting, watching, and looking for correlation, especially how factors in the web world are going to impact the financial world.
Okay, Harris, great to see you. Thank you.
Thanks, Catherine.